last week we talked about group life insurance. That's what we talked about for the past 6 weeks. Just like when I was starting this series, I told us that for 5 to 6 weeks, we'll be talking about why life insurance is a benefit to the assured. And this is the 6th week. No, the first time, the first series with the first series of this topic, we talked about the term assurance. The following week, we talked about the whole life assurance. We went ahead to talk about the endowment policy, and we talked about annuity. Then last week we talked about the group life insurance. And today we'll be rounding up this series. And I want to believe that those of you that have joined me on this series, I believe you must have, learned 1 or 2 things from life insurance. You must have seen that life insurance is indeed a benefit. It is not as what people think it is. It is actually a benefit to the assured. So we learned a lot of things in the course of this series. It's a benefit to the assured. It's a benefit. It has benefit to the assured. It has benefit to the beneficiary. The name, the beneficiary. But for you that you are taking it principally, it has its own benefits to you. And today we'll be rounding up this series on why life insurance is a benefit to the assured. We'll be rounding it up with credit life insurance, the group credit life insurance. What do I mean by credit life insurance? For those of you, if you're into a business or maybe you give out credit facilities, you give out loans to people. If the nature of your business is into, giving out credit facilities to people, then I believe this topic today will be of great benefit to you, because lots of people, they do not know that they can save themselves lots of stress by just picking up credit life insurance. Instead of you, you feeling, well, you are grieved if your debtor is no more. You feel, oh, your business can crumble. Your business will not crumble if you put things if you do the right thing. If you put credit life insurance, when you give out loans to people, maybe you give out credit facilities, the debt of your debtor, the debt of your borrower or debtor should not have anything to do with your business. If you have the knowledge of credit life insurance and you put credit life insurance when you give out facilities, credit facilities to people. So this evening we'll be talking about the group credit life insurance. We'll be talking about credit life insurance. So let's look at the features of credit life insurance. Let's look at the features. The features of credit life insurance, it's an annual contract, and the cover is meant for creditors. Who are the creditors? You who are in the business of giving out the credit facility. You are the creditor. The person who wants to borrow the money is the debtor. So the cover is meant for the creditors. You pick it's an annual contract. Insurance contracts are, most of them are usually an annual contract. Then it's meant for you as the creditors, and it is the creditors that pays the premium, because it's actually meant to safeguard your business. So it is you that you pay the premium. Actually, credits, the creditors factor the premium into the terms of condition of the contract. Yes, it is you that pay it, but invariably it is the debtor. It is part of the costs of securing credit from you, the creditor. So in the cost of preparing your documents or terms of agreement, definitely it's usually factored into maybe the repayment plan for the debtors, but at least it is recognized that it is the creditors that pay the premium. Then the borrowers are not party to the contract. The borrower only have contract with you, the creditors. When the borrower comes to borrow money from you, you have the contract is between two of getting the loan facility. But the credit life insurance that you as a creditor you are picking, the borrower is not a party to it. Now the credit duration must not exceed 3 years. If you want to give out loan and you feel you want to pick up credit insurance, the credit insurance, it's one of the conditions that the maximum duration of the credit facility can give is actually 3 years. In fact, most people like microfinance banks, like all these creditors, usually it's even the loans are actually in terms of maybe few months, maximum 1 year. But at least the features of credit life insurance says you give out the maximum duration should not exceed 3 years. I hope you can relate with that. So let's look at the benefits to the borrowers. Let's look at the benefit to the borrowers first. Now, this policy, the credit life insurance, protect the family of the borrowers from embarrassment. How do I mean? Let's look at the scenario. Maybe you pick up mortgage plan. Maybe you want to buy a house. Maybe as a breadwinner, as a family man, you have a property you want to buy, and you secure a mortgage loan, for example, to buy that house. If in case of death, if death comes and you are not finished paying the mortgage bank will just, once you are no more, the mortgage bank will just come and evict your family from that house because you have not been finished paying the mortgage loan on that house. But if there's a credit life insurance attached to that mortgage, that wouldn't happen. What the mortgage bank or the the people that give you that mortgage loan, what would they just be? They'll just call on the insurer to give. I mean, it is that credit life insurance that will now speak, that will now pay up the outstanding balance. So that is what I mean by the policy protect the family of the borrower from embarrassment. I hope we can all relate with that. Now, it provides a level of peace of mind to the debtors that in case of eventuality, their debt will be written off. That does not mean that the debtors will not be lackadaisical about it, but it's just that at least it calms you. When you have debt and you are not thinking of how do you pay your debt and all that, but if you have to understand that there is credit life insurance, not that you will not now work towards paying the loan, no, but at least there's a way it calms you. There's a way it gives you that support that even if you are not able to finish up the payment, that's at least your family will still be catered for. Now, let me cite a scenario here to buttress this part. Now, let's say you have a facility you are servicing maybe for 1 year. Let's work with example now. Now, maybe life happens. That is not what we all pray for, or we always plan for when we are doing our plans. But it happens. Maybe in the course you have 1 year to pay your loan, and maybe you have just paid like 4 or 5 months. Now, if there is debt, this credit life will pay up the outstanding debt. You have paid like 5 months. So the remaining 7 months, the credit life will help you pay it so that your family will not be embarrassed, or your family will not be, if it is a mortgage loan, they will not be evicted from the house. So that is what credit life does. But if you not think because you have credit life, you now want to be like a Desica, you don't want to be paying your loan, let's say you are supposed to have paid 5 months. Are you with me? Let's say you're supposed to have paid like 5 months or 6 months before then, and you have just paid 1 month. Your credit life will not pay those 4 months, those 5 months that were owing while you are alive. If you are alive and you are owing, your credit life will not pay it if you are no more. I hope you can all relate with what I'm saying. I believe you can get what I'm saying. So credit life insurance does not give you permission to be like adversical to say, oh, since I have insurance, I'm not going to I mean, I can even maybe if I have the money, I can even still quickly use the money to pay my loan. You can quickly use it for another thing. It doesn't work like that. So what your credit life will do when you are no more is those repayments you are not able to do because debt takes you away. That is what credit life will cater for. But those loans you are supposed to have repaid while alive, credit life will not pay for it. I believe you can. I believe I've taken out time to explain this very well. So credit life does not give you authority to say, oh, to be lazy around. No, just like I told us when we started this program on one of our discussion that insurance don't pay for intentional risk. Insurance speak for risk that is fortuitous. So you will say because you have credit life and you will now not pay your loans. No, you will pay it. Credit life will only speak when debt takes you away and you are not able to complete your loan. I believe I've been able to stretch that point very well. Now let's look at the benefit to the lender. You know, the topic, you know, this series, what we've been talking about is the benefit of life insurance to the assured. Now, let's now look at the benefit of this credit life to the lenders, that is, the people that give out the loan. It provides cover for the outstanding debt of the debt. It provides cover for the outstanding debts on the debt of the borrower. Just like what I've explained, that it is when debt takes you away and you are not able to complete your repayment, that is when credit life speaks. And to the lender, it's a benefit because the lender will not lose you and lose their money. You know, if debt takes you, you are not able to pay the lender their money. You know, that is, I mean, this on the lighter mood now. If somebody dies and the creditor is there crying, you might think it's because the person loves that person. Like, it might just be thinking that, oh, so my money has gone down the drain. This is on the lighter mood, but that's the reality. So the lender will not have to suffer that, oh, you are gone, and at the same time his money is gone. No. So it's a benefit. Credit life insurance is a benefit to the lender because he knows that although you are no more, at least he will still recoup his money from the life of his. So it protects the working capital of the lender, because if lender is giving out money and all the debtors are dying, it means the business is dying. But with credit life insurance, I mean, it will protect the working capital of the lender. Do we understand? I believe we can relate with what I'm saying. Now, claims are paid to the lenders when credit agreements and debt certificates are provided. I mean, it is the lender that receives the benefit, the claim benefits. You know, when in cause of death, the lender receives the claim. It's not the family. It's not the family of the disease or the family of the debtors that collect the benefit. It's the lender. So it's a benefit to the lender. Now, it provides peace of mind to the lender that he could recoup his money from the insurer in case of death. In case of death, that is, if the debtor dies, at least the lender has that peace of mind that he will always get back his money. So credit life insurance is a benefit to the assured, to the lender, to both the lender and the debtors. I hope we can all relate with that. Now let us look at okay, the underwriting considerations. You know, there's a, for you to pick up a credit life insurance, your turnover, there's usually a threshold. It depends on the life of it, or it depends on the terms of the contract. Your business must be a viable business. It must be an organization. You must be in that business of giving out money, like maybe a microfinance bank, a mortgage bank, lenders, credit houses. So it must be a legal, your business must be a legal personality, and there must be a particular threshold for you to be able to pick up that credit life insurance. Then the nature of the business of the borrower. Let's say, for example, if the borrower, somebody wants to borrow money from you, and basically that his business cannot sustain the loan, as a lender, you will not be encouraged to give the person loan. So the number of the group, if it is a group life is a group credit life, because normally the lender, it must be that you give out loan to a number of people. So the volume, actually in insurance, volumes, or when you are doing group, the more the volume you have, attracts discounts. I mean, you'll be given some discounts if you are dealing with volume, a large number of people. Then the age of the borrower. I mean, you cannot say a 70-year-old or an 18-year-old man, you want to give them loan. I mean, those age have passed the active years. Those ages are not in the bracket of age that's still that are considered as active age. So I mean, age is always a factor in insurance. It's always an underwriting factor. Then the credit history. The person you want to give out loan to, is it the person that he will always want to collect loan, but he will be reluctant to give to repay? No, credit history is also an underwriting factor when you are seeking for credit life insurance. So these are the considerations. These are some of the considerations you look out for when you want to secure credit life insurance. So on this note, I want to stop because of our time, and I want to entertain questions at this time. I'm seeing one hand up already. Madam Yewande, kindly unmute and ask your question. Thank you very much, everyone.
Okay, Madam, well done. Thank you so much for what you're doing.
Thank you, ma'am.
Credit life insurance, that's what you taught us.
Yes,
today,
credit life insurance.
I think I have like 2 questions.
Okay, go ahead.
One is that you said, is the borrower, the person that borrows money, that will be paying premium. Okay. I mean, that will sign up for this type of insurance, right?
No,
and as the person is paying back the loan.
You didn't get my point. It's not the borrower, it's the lender. The person that is lending out the money is the one that is taking the credit life insurance to protect his business. Do you get it now?
You said, from the example you gave,
okay,
you said that, okay, for example, if somebody is on mortgage for 12 months, with his 1 year, that if the person signs off for this credit life insurance, and probably the person is able to pay like 5 months out of the 12 months before the person dies,
Okay.
And the insurance will pay off the remaining 7 months.
Yes.
Huh? That's
Yes.
for mortgage.
I
So
use
that
it
means
as
the person
example.
that is paying, yes, I'm just trying to clarify this issue.
Okay.
That means the person that is paying back loan is at the same time servicing the insurance, right? Anyway, insurance is paid once a year. So
Yes.
what percentage of the money owed what percentage of the mortgage is this credit life insurance going to be? Because if from the example you cited now, from the example you gave, somebody take mortgage for months and subscribes for a credit life insurance, and the person dies after 5 months. So that means the person would have just paid once, as in the person subscribed for the credit life insurance will be the only time this person would have paid before he dies. And still, insurance will still pay the bill because insurance payments is it not just once a year?
Yes.
You getting what I'm saying? Are you getting my question?
I'm getting you.
You're not getting my question. Eh?
I'm getting you. You are
So
you are thinking.
I'm kind of confused.
Okay.
I'm kind of confused because there are two different things. The example you cited about the example you gave us about somebody paying mortgage for 12 months and that of the person that borrowed money, I was even thinking is the borrower that will subscribe for the if you had said that the borrower will subscribe for the credit life insurance and still be paying for the loan, so that in case, because you mentioned, you emphasized on the fact that you shouldn't, because you have subscribed for the insurance and now be lackadaisical about the payment, that the month that you are supposed to have paid while you are alive, if you don't pay it, insurance will not take it, will not pay those months.
Okay. Thank you, madam.
So I'm
Just
kind
like
of confused.
yes. Let me reiterate it. Let me reiterate what I said. You say is that credit life insurance is always like is a criteria when you want to take loan. When you want to take loan, no, on your own, you may not think of it, but it is a lender that will compare you sort of that, okay, most times they factor it into the loan you are taking. It depends on the structure of that loan, of the facility. Like if it is like mortgage would have said, okay, before we can give you this mortgage loan, you must pick up credit life insurance. Mortgage can ask you to say, okay, go and pick it your own. Or they can still factor it inside the repayment plan, inside the repayment of that mortgage loan. So it depends, but just like I've explained it, the credit life, it protects the business of the lender. So it's usually the lender that are always active, or that are always make it as part of the criteria for you to collect loan. So they either factor it in their repayment plan, or they say, okay, you go and take it. Do you get it clearer now?
Yes.
Do you get it clearer now?
Yes,
I can't hear you, madam. Hello? So whichever the case, the issue is, it is for the benefit of the lender, because the lender wants to secure his business. So it is the lender that always ensure that credit life insurance is purchased. I hope you can get it now. Do you understand?
Yes, I understand now.
Okay.
I do.
Thank
So
you,
my second question is that what if the borrower is able to pay up everything and he refuses to die? As if he does not die, for example, with still going by the example you gave,
okay,
that somebody paying for mortgage, the person is able to clear up the mortgage loan and and he's still alive. So what happens to the money?
Yes,
Has he just gone into
because the person has taken insurance does not mean the person should go and die. Yes.
Now what I'm saying is, what if the person is able to finish paying and is still alive?
It's okay.
So
Thank
what happens to the
alive.
money?
Thank God the person is still alive, just like your car insurance. See, each time we are looking at insurance of this like 1 year contract, let's look at that car insurance. You know, when you pick up car insurance in a year, if you do not have any cost to make claim, I mean, you have paid the premium for your peace of mind. So in insurance, those who are lost, those who are crying, those who are happy are the ones that pay for those who are crying. That's the main explanation for insurance. Do you get it?
Okay, I do. I get it.
Okay, thank you.
All right, thank you.
Thank you, madam. Mr. Peter, kindly unmute and ask your question, sir.
Okay, good evening. Thank you very much for that wonderful presentation. I have two questions quickly.
Okay, sir.
One, what are the types of credit insurance that we have? Then number two is if somebody, the way they normally arrange it, if you take a facility from a bank or a finance company,
sorry,
so they will
your internet, I didn't get your second question, please.
Okay, the second question is this. Can you hear me now?
Yes, sir.
Okay, if
you take credit facility from a finance company or a bank, what they typically do is that as at the time you are taking the loan, they will tell you, they will charge you for insurance. And then it's the bank or the finance company that will go to insurance company to get that credit insurance.
Yes.
So if anything happens unexpectedly, then your family does not need to worry. But my question is this: what happens if somebody loses his employment and he doesn't have the means of paying back the money? Will credit insurance cover for that to the lender? Or what is it only if the person dies that the insurance company will now indemnify the creditor? I need you to clarify that so that we'll be able to drive home the point that we think that we have learned in this presentation.
Okay, thank you very much, sir. I really appreciate you for that question. I cited Mr. Fatai at this bureau. Mr. Fatai, sir. Good evening, sir.
Good evening.
I want to give you the floor to answer Mr. Peter's question, sir.
Good evening, everybody.
Good evening, sir.
Thank you for the good work.
Nice having you today, sir.
Thank you as well. Regarding Mr. Peter's question,
yes, sir.
The primary purpose of taking a policy is to protect you against any eventualities. When you are talking about credit, it can be easily divided into two. There's one that is called the mortgage protection policy, and the other one, credit insurance or credit bond. We have all those ones. And if anything happens, as we talk about the unemployment, when you go into any contract, you are expected to fulfill your obligation under that contract, irrespective of what might happen to you. That you are expected to repay the loan so that your family or you yourself can have that item that you bought, that may be a vehicle or house. If per adventure, one loses his job, you are still bound under the contract to pay. So the credit insurance is for you to take care of in case of untimely death, mostly, more often than not, if it is the mortgage protection. So we have another policy, unemployment policy, that can come to your aid to fulfill that. So when you take on employment, loss of employment policy, so that will come to your aid to make good all as if you are still earning your salary and it's from your salary that you pay you meet your obligations under the contract of loan agreement that you had. So that's it. I want to chip in another thing. We have mortgage protection for those who are buying house, and more often than not, the premium is paid once, irrespective of the number of years that it's going to take you to repay. And the purpose of that is that in case of untimely death, your family members are not thrown out of the house. As Madam said, if for any reason you refuse or you fail to pay some installments, your family is bound to pay that due but not paid installment. The underwriter will only be responsible from the period of death to the end of that agreement. I hope I'm clear, Mr. Peter.
Thank you very much, sir.
Okay. Thank you, sir, Mr. Fatai Adebero, for your contribution. So thank you, Mr. Peter, also for asking that question. Yes, I just, before we go this evening, I want to share my joy with everybody in the house today. Yesterday was very phenomenal in my life. I had another feather to my to my cap. I'm happy to tell the whole house, that yesterday I was inducted as a member, as an authorized dealing clerk with the Nigeria Exchange Limited. So I just feel like I should share the good news. Thank you.
Congratulations.
Congratulations. I just feel I should share.
Congratulations.
Thank you, sir.
Congratulations.
Thank you so much.
Meaning you'll be wearing red jacket now.
We only wear the red jacket on the floor.
Red jacket now.
On the floor.
We should look out for you. We should start watching FTA News now to look out for you.
Thank you. So on that note,
congratulations,
thank you, madam. Thank you, everyone. On that note, I want to bring this meeting to a close. I want to appreciate everyone that have been following me on this program every Wednesday between 5:30 and 6. And those of you watching me on Facebook Live, I want to say thank you. If you have any question, just chat it. I will respond after this call. I will respond to your questions. So thank you, everyone. Let's meet again together. And I always upload this program to my YouTube. You can always, you can visit my YouTube, Grace Ojo blog channel. And you can like it, you can, broadcast the link. I really appreciate everyone. Thank you so much, and let's meet again next week.
Okay, madam. Once again, congratulations.
Thank you, ma.
Enjoy the rest of
have a wonderful day and have a wonderful evening, everyone. Let me stop the slide and see people's faces.
Congratulations, madam.
Thank
God
you.
Bless you.
Thank you so much.
Done.
Yes. So let's meet again next week. Motola, Hakim, Mr. Lawyer Folonshaw, Maya White, everyone that has joined me, I want to say thank you, thank you. And Silverland School, thank you, Mr. Fatai. Thank you, sir, for your contribution every time. Thank you, everyone. Do have a wonderful evening. Bye-bye.
Bye. Thank you.
Thank you.